Welcome everybody to our 22nd episode of our Bay Area Housing Market Town Hall. Today, we are going to talk about the Bay Area housing prices and housing activities, the mortgage rate trends, and the inflation and the CPI talk that we've been hearing, and really understanding a little bit about one of the causes for this high inflation, and then what does it have to do with real estate. And then, of course, we're going to end with our multifamily markets regarding the rental rate trends and also the California markets. All right. So here we go. Let's take a look at the Bay Area housing supply right now. Thank you so much for watching. And don't forget to subscribe to our channel and also come back often to check out our new videos. As you see that the trend line here, number of sales here, we always see that in July, usually it goes up because of the summer situation. So when summer comes, sellers are more ready to put their property on the market. And especially, we've been talking about that we have very low inventory. And because we start having vaccines, so sellers are more willing to come out and start selling their property. So we did see a little bit of an uptick of the active listings, but look at compared to last year and the year before and 2018 is absolutely very low. It's really nothing compared to what we used to have. So the inventory is still very low. And this is why you continue to see the prices going up. So this chart, it shows that the sales price to list price ratio, on the yellow bar, we saw that last year, August, it's a little over 100% over asking price. Well, this is obviously we have some anomaly here, but then still you see the trend actually continue to go up despite the prices have gone up quite a bit. And then the number of sales did not come down either. The number of sales actually continue to go up. So with a very tight inventory, we actually have a lot of activities on the market. We're talking about we actually have more sales compared to last year. And what about we look at each county individually? If we look at Santa Clara County, the housing stats, the average days on the market for the single family has gone up slightly, just one day, but of course still really low compared to last year. And for the condo market, the days on the market is about 17 days versus 19 days last month and 35 days last year. But if you look at number of closed sales, we actually have slightly less in Santa Clara County. It's 7.2% less compared to a month ago, but compared to a year ago, we are still 22.2%. And this is talking about the closed sale in July, meaning that these are the property, they went under contract in June, right? So they closed in July. And same thing for condo and townhome, they have less closed sales compared to last month by 11.3%, but then compared to last year, we had increased by 58%. And in terms of the pricing, came down a little bit to 4.6%, but compared to last year, it's still about 20%. While same thing for condo, it came down slightly compared to last month to $900,000, but had gone up 8.5% compared to last year. And for San Mateo County, also, we saw that a little bit, the pricing had come down a little bit for July compared to last month, came down about 3.9%, and it stayed on the market slightly longer, 2 days longer, and it has actually less sales for this month compared to last month. And then in terms of the condos and townhomes, and the price also have dropped. It dropped by 3.7% to 922,000. And the average days on the market is 24 days. And also the closed sales is 154 units compared to 187 units last month. So it came down a little bit. If you remember a couple episodes ago, we did talk about the summer. That's what we're going to start noticing. The summer is going to slow down a little bit. The pricing probably going to be a little bit more moderate. It's not going to be as active. And this really, we start to see that for both San Mateo and Santa Clara County. So what about Alameda County? Alameda County, we're seeing almost similar trend, is that it did come down a little bit to $1.146 million for East Bay in general. And while we look at days on the market, it's days almost around the same. It's just a day longer, but it's practically the same. It's only about 14 days versus 13 days in June. And we did see a big, huge drop starting from January, though, from 26 days all the way down to 13 days. Now, we usually compare at the year before versus this year on the pricing, but this time I want to show you guys, instead of compared to year over year price change, I want to show you from last month to this month. As you see from last month, June 2021 to this month, there are a few cities that have dropped in prices. Alameda dropped down to from 1.6 to 1.332. Hayward is 940 to 904. Newark 1.2 to 1.18. San Lorenzo from 875 to 850. Union City from 1.4 to 1.38. And in the Tri-Valley, Alamo had come down as well from 2.68 to 2.5, but all the other cities actually have come up a little bit. Here in West Contra Costa County, we see that for El Cerrito and Pinole, they had come down a little bit on the pricing, as well as Concord, Martinez, and Pleasant Hill has also come down in pricing, and also Orinda. So what about our actual activities on the ground? As I usually every month, we show you a little bit what we've been doing. And these are just some of the notable offers that we have made within our team. And as you see that almost all of these, if it's not multiple offers, will be preemptive offers. And even preemptive, they have multiple preemptive offers. So let's look at the East Bay and Fremont area. These are all single family. I guess apparently this month everybody was making offers on single family, but every single one of them had gone up quite a bit. It's like 100,000 over asking price, and this one from 2.8 got a cash offer and pretty much $425,000 over asking price. And even Milpitas 1.425, they got 5 offers within 3 days and had gone up to 1.687. And then we have Silver Creek, Cambrian. These are all in San Jose area. Evergreen, Berryessa, and Campbell. They all received quite a few multiple offers and way over asking price. And Sunnyvale, Cupertino, and Saratoga, these are a little bit higher price point. And as you see that these have double digits number of offers, 19 offers. Well, this one's 7, but this one has a cash offer. And then here 11 offers, 13 offers for Cupertino and Saratoga. And they have gone way over their asking price, especially this one, Cupertino, as you see that it has gone almost $1 million over asking price. So the market is still quite active, and these are most of the offers that we have made in just the last 30 days or so. All right. So what about the mortgage loan situation? And they have adjusted their projections again. Every second Wednesday of the month, from 4 to 5 p.m. Pacific time, we will be doing our Bay Area Housing Market Town Hall and bring to you a lot of great speakers and to share a lot of real estate information. But good news is that they had adjusted down. So now they think that 3Q 2021, the mortgage rates for Fannie Mae Mortgage Bankers Association and National Association of Realtors believe that they're going to come down, and their adjustment is quite large. It's 30 basis points compared to what they have predicted before. So now their average of all has come down to about 3.1% for the 30 years fixed, while for the 4Q 2021 is going to be about 3.3, 1Q 2022 will be about 3.43, and 2Q 2022 about 3.58. This is the only one for Mortgage Bankers Association that predicted that 2Q 22 is going to go up a little bit more to hitting 4.0. But in general, all the agencies believe that the rate, the 30 years, is still going to be quite a bit below 4%, although it's in the upward trend. A lot of people also wonder, okay, now we are over a year and a half into this whole COVID pandemic, and we've talked a lot about because of these moratorium and that can cause foreclosures. We still have people talking about that. They believe there's going to be huge foreclosure waves coming in, and I still don't see it from the statistics that I'm looking at and research on. As you see for California, here is the delinquency percentage 3.1, foreclosure percentage is 0.1, so total non-current is about 3.2. As a matter of fact, it has reduced 50.5% year over year in the non-current loans. Basically, people are not paying for them for their mortgage payments. So I'm still really hopeful, and we are doing really well compared to most of the other part of the country. And in terms of in the national level, if you look at compared to 2008, we had a total of over 4 million non-current mortgage loans. And now, as of June 30th, 2021, we have come down to 2.465. We did have quite a high number of the non-current at about 3.3, but since then we have been coming down to 2.465 million of total non-current loans. What about inflation now? We've been talking about inflation, news been coming up, and just today, here's CNBC talked about July consumer prices jumped 5.4%, but core inflation rises less than expected. So what does that mean? Now, before we go into this, we do need to understand that what does CPI stand for, and how does it include housing units? A lot of people think that, oh, well, of course, the housing price have gone up so much, but the CPI views housing units as capital or investment goods and not as consumption items. So that's actually not being calculated in part of the CPI. So spending to purchase and improve houses and other housing units is investment and not consumption. So I just wanted to make it clear for everybody that when we look at CPI, we are not including anything that relating to the housing or real estate. So this is what we are looking at. The CPI, as we see that it has been pretty low, around 2 or even down to 1%. But then it just jumped. And this is truly quite high compared to in the last 2 years. And according to Todd Horowitz from BubbaTrade.com, actually, if you guys want to look up on YouTube, just look up Bubba Horowitz with KitCo News. And he was pretty passionate about this topic. And he really believed that government is the one who created this high inflation because they have been providing these stimulus packages, allowing people not needing to go back to work. So we actually have this oversupply of jobs, but not enough labor to come into work. And CNBC also mentioned that employers who have struggled to find workers have hiked pay or offered signing bonuses to help fill the record 10.1 million job openings across the economy at the end of June. But instead of absorbing higher labor and material costs, some businesses have begun to pass on the impact of higher wages to their consumers. So this is like really important to see that part of this, when we cannot find labor, when people don't go back to work, the employers have to pay more money to hire these workers. At the end of the day, these employers or business owners, they have to pass these costs to someone else, and it will always end up going back to the consumers. So this costs a lot of products with higher costs as well. What he had mentioned is that he does not believe this inflation is peaked. He believes that the inflation is going to continue to go up even more. So what does this translate to real estate is that, as you know, that for California, we have a statewide rent control by AB 1482. What does it say is that annual rent increase of 5% plus the annual CPI percentage change on all rental properties that are not exempt from AB 1482. And CPI percentage change should be based from April 1st of the prior year to April 1st of the current year for the region where the property is located. So you do have to do some research, especially, your property managers definitely can help you with that. But if you are in an area that does not have their own local city more restricted rent control, then you are still part of the statewide rent control. Then you need to know what is the CPI is for your area, and then plus 5%. Then that's the max that you can increase on the rent. So if we look at the San Francisco area, the numbers that you probably can use, it would be about 3.8%. But again, this is just a general Bay Area number. If you have somewhere, for example, if you're in Sunnyvale, then you're going to look up the CPI number that's closest to the Sunnyvale, could be San Jose area if they have that number. So again, be sure to talk to your property manager to find out what is the CPI number for your area. So if it's 5% plus the 3.8, then that means the max you can increase the rent would be about 8.8%. So so this CPI increase, meaning that you can actually increase your rent more As you see that in the past, it's been 1.1. If 2020 is 1.1, then that's only 6.1% that you could increase. So this number is actually allowing you to increase your rent a little bit more, especially if you're purchasing a new property and the rental income is really low, you can increase it a little bit more. All right, so what about the office market? And I want to show you this through the Site Selection magazine. This is a lot of companies actually look at to determine which markets they should go to invest. And they actually look at a few criteria, including workforce skills, workforce development, transportation infrastructure, ease of permitting and regulatory procedures, state and local tax scheme, right to work state, utilities, quality of life, incentives, and legal climate. And the top 10 is number 1, Texas. And number 2, we have 2 areas tied, North Carolina and South Carolina. And number 4 is Georgia. Number 5, Tennessee. Number 6, Ohio. Number 7 is California. So even though a lot of people have been complaining about California and talk about this California exodus, but California is still the top 10. And then we have 2 states, Utah and Virginia, tied at 8, and Arizona is number 10. And Casey Conway, who is the chief economist for CCIM Institute and also director of research for Alabama Center for Real Estate, he had shared some information regarding this as well about California. And one of the main reasons why, as you see, actually in California, the business tax climate is ranked 49th. And as we all know that we do have a pretty high tax state here. But then in terms of the higher education R&D expenditure, we are ranked number 1. And also we have ranked first on the GDP growth rate trend. We know that a lot of companies still consider California top 10 areas to invest in, but we do see that a lot of big tech companies, they did postpone the return to work in the office. Twitter, Facebook, Google, and as well as Asana, Lyft, they all have postponed and delayed their return dates, some to October for now and some to February 2022. So we definitely have to take a look further. Hopefully we can really contain this Delta variant. I'm not confident we can contain it, but at the same time, I think we do need everybody's cooperation to help so that we can allow these companies to allow a lot of their employees to go back to work if they want to. So rental housing market, surprisingly, not just about the sales market that's been really hot. Actually, it's been on the news talking about the demand for home rentals rockets as tenants get into bidding wars. So even tenants are getting into bidding wars. Zumper had said that 1-bedroom apartments had increased 7% year over year in July. So compared to 2020, 2021 July has increased 7%, 2-bedroom 8.7%, and then single family rentals had increased by 6.6%. This is what they said, is that Americans who lost their jobs because of the pandemic rushed to find cheaper housing, pushing rents higher for the least expensive apartments and homes in the suburbs. So we've been talking about the suburbs. They did not crash like the metropolitan areas like San Francisco, New York, and Oakland, San Jose area during the pandemic, especially in 2020. But they have been holding their rent pretty well. So let's take a look at a few of these cities though. So year over year, for example, San Francisco, let's look at San Francisco. It did drop 15% year over year, and then still kind of dropped 2.5% compared to last month. But there are a few areas have recovered quite well. Emeryville has come back 5% month over month. Santa Clara as well, 5%. Sunnyvale come up 5%. These are top three that have come up. And in terms of the 2 bedrooms, Menlo Park had come at 5.1%. But Berkeley, you see here, Berkeley is still coming down at 3.3%. So we do have some areas that are doing pretty well and some areas still trying to catch back up. But I think most of these cities, we are going to the right direction right now. And here is a chart compared to other large cities in the country. And as you see, the San Francisco and Minneapolis, actually, they are both still year over year still down quite a bit. And even month over month is still down. But then if we look at Oakland, it's kind of break even. And same thing for Los Angeles, but San Jose has come down. So San Jose actually is leading among all the other metropolitan areas in the Bay Area right now. And we talked a lot about people moving out of the Bay Area. And this is an interesting chart because there's been a mass exodus of renters out of the Bay Area in 2020, but there's also a growing interest in new renters moving in to replace them. We keep hearing the news talking about people moving out, but they don't talk about people moving in as well. So this is a good chart to show that, yes, we have quite a bit of people moving out, but we also have quite a bit of people coming in. And one of the reasons is probably because the rent had gone down so much for those people who always wanted to live in the Bay Area, maybe San Francisco. They feel like, oh, now I have a chance to actually try to live here. So this is a quite an interesting chart. So to keep everybody a little bit more optimistic, it's not like everyone really moving out of California. As a matter of fact, I just came back from Chicago for a conference, and I met with a lot of commercial real estate professionals around the country, and everybody was talking about, well, how are you guys doing? I heard that people are really moving out of California, and how's your market? And I kept saying, like, our market's doing really well. And they're like, well, people are still buying. And I said, yes, people are still buying. There's still a lot of people in California. It's not, I do feel like the news is kind of blow it out of proportion. Talking about so many people have left. I do agree there are people who left, and I know personally a lot of people left as well. But at the same time, there are still a lot of people activities within our area. And in terms of rent payment tracker, we show this every month. We are still in a relatively healthy state. We still collecting about 95% full month for month of July. And Yardi matrix, if you know Yardi, a lot of property managers, they use Yardi to do their property management reports. And it's interesting, on their national multifamily report that came out in July, it says gateway metros are recovering quickly with substantial month-over-month rent gains. San Jose leads 3.6%. Followed by Boston 3.2%, New York 3%, Miami 2.7%, San Francisco 1.8%, Chicago, Washington, D.C. both at 1.5%, and Los Angeles at 1.2%. So of course, when I saw this, I was very excited because I really do feel it on the ground where San Jose area, when they call San Jose, it's more like a Silicon Valley area. It really did improve quite a bit. And here it says that multifamily and real estate in general has always served as a hedge against inflation, asking rents for multifamily are rising at their fastest rate in decades, while the single-family rental market is experiencing the same rapid price appreciation. The surge in rents does not seem likely to fade anytime soon, as there is significant undersupply of multifamily housing in most metros, creating robust demands. And as you see that here, month over month rent growth on all asset class, and you could see that, and even these, I only highlight the ones in the California, San Jose about 3.6% we mentioned, and then Sacramento is over 2%, San Francisco slightly less than 2%, and Los Angeles slightly over 1%. And we are still seeing the month over month rent growth. Now, my conclusion is that the housing prices, we're still increasing, but we do see a bit cool down in the summer because as I mentioned, a lot of people have gone on to vacation. We just see a little uptake on the supply in July. I think because what we saw is actually back in June timeframe, and then we recorded in July. So next month, I think we're going to see a little bit even more uptake on the supply, but the interest rate is still really low. It's still decreasing compared to last year. However, we're going to start seeing it to go up very slowly. Unfortunately, inflation has not peaked, meaning a lot of our consumer products probably going to get more and more expensive. So that's why the best hedge is to own real estate, and I'll explain a little bit more why that is. And In terms of the commercial real estate market, California market is still considered an ideal place to invest. It is still a top 10 place to do business. And also the rental rates are recovering across the country, and San Jose region leads the recovery in the Bay Area. So now I mentioned that why, in terms of inflation, the best hedge is to own real estate. So just think about that. If there's inflation, the rent could increase as well, right? So I want to use this example to show you guys. Understanding, especially 5+ units, the property value calculation is based on net operating income over cap rate. So if I'm just going to give you a very, very simple example. Imagine if we are buying in the Bay Area and you own 10 units versus a suburb area and you own 10 units. Both areas, you increase rent per unit by about $100. So your total annual rent increase is $12,000 for both properties. Now, the only difference is that in the Bay Area metro area, the cap rate usually is lower. Let's say it's about 2% lower than the suburb area, right? By using this same formula, assuming everything else stay constant, you just increase your net operating income, assuming your expenses the same, you just increase your net operating income by $12,000. Then in the Bay Area, using this formula, your property value increase will be increased by $300,000 versus in the suburb, you increase by $200,000. Now, if your rent increase is more, then you'll see this significant difference. Now, instead of just $100,000 difference, if you increase your rent like by about $300 per unit, with 2% difference on the cap rate, you increase your property value by $300,000 more compared to buying a property in the suburb. I absolutely love buying properties in suburb area because there are just more opportunities and it's more affordable to purchase. I just want to show you guys why there are still so many investors are buying in the Bay Area despite with such low cap rate is because of the power of cap rate and how it can increase your property value. So if your inflation causing your rent increase faster, then your property value is going to increase even faster. And this is why real estate is such a good way to hedge the inflation. Thank you so much, everybody, for attending our August webinar. I hope that you learned a lot. And again, to remind everybody, please subscribe and you will get notified as soon as our videos are available for you to show. Well, thank you again for attending. I'll see you next month. Bye.